Welcome to the office and the industrial panel. I'm here with Nate Stevens from the Bullis Company and Sam Leggett from the Dunham Group. And we are going to have a little bit of a different pattern than we did last year. So we're going to do an initial sort of data dump from these gentlemen on each individual market. That was a strong request from last year's format. And then after each of them have an opportunity to kind of give us some background on what's been going on and download some of the data. From there, we will be going and having a roundtable discussion, and there will be time for some questions at the end. So we're going to start off with Nate Stevens. I'll let you introduce yourself, and then we'll go from there. Do you want the clicker? Oh, yeah. Here you go. Oh, and just to introduce myself, my name is Jennifer Small. I'm a partner broker at Malone Commercial Brokers, and I am also the vice president of MEREDA. All right, all you, Nate.
All right, thanks, Jen. As Jen said, my name is Nate Stevens, managing partner, designated broker at the Bullis Company. Thank you to Merida and Jen for inviting me back again to talk about the office market, where we are, where we're going. The last couple of years, I've kept things anecdotal and talked more about trends and tried not to say the words vacancy rate. But you guys all wanted more data, so you asked for it, you're going to get it. So that'll be the kind of the first part, and then we'll dig into some trends as we move on. So a lot of the data, you know, I say this every year, we compile this, it is real-time data. We call on all the office buildings, Class A and Class B in Greater Portland. You know, you can search the websites, you can ask AI, but as we heard this morning, AI lies. So this is real data, and you can rely on it. So we're pretty proud of what we do. And this year, you know, 6 years post-pandemic, I'd love to get up here and not talk about the C word, but COVID, by the way. But we're still reeling with it. And here's my first slide. This is, you know, the last 20 years, the orange bar is the direct vacancy rate. And for the Greater Portland office market, that increased to 8.84%. So it's pretty evident when you look at the timeline here, this is still something that we haven't even gotten to the peak yet, let alone talk about recovery. And 8.84% is the highest rate since 2012. Really, the fallout from the financial crisis through 2012, it was higher. So that's not great for the market right now. But if you look at, and actually in addition, if you look at the little blue line at the bottom, that's the sublease rate. And so while we have a lower direct rate than we did in 2010 and 2012, the sublease rate was much lower. So when you take the total rate, which you can see here is 11.3%, that's right where the market was 14 years ago. So not a whole lot of improvement. That was a very fast climb to 10% direct, and actually a fairly quick recovery. This is a much slower climb. And really, I think the difference was the financial crisis. Those were companies going out of business and shutting doors and giving the spaces back to the landlords. This has been much more of a strategic decision by companies. Do we need the space? Do we need different space? Do we want a different location? Do we want to pull out of the market? So those conversations are still happening with some of the large users. I guess now that I have all the landlords in the room depressed, the good news is that this little blue line at the bottom, you can see the sublease rate has decreased 2 years in a row. So the direct rate has kind of been fed by the sublease rate. As spaces turn over, they become direct leases, whether it's 1, 2, 3 years. And seeing that number goes down, that means less companies are making a decision mid-lease that they need to get out. And I think that's a good sign for the future. If the market will follow the sublease rate, that could mean in the next couple of years, after a plateau, we could see things starting to fall. The other good thing, which is also interesting, is that there was about 140,000 square feet of positive net absorption in our market last year. And really, that just takes the amount of space that was vacated and the amount of space that was occupied over a 12-month period. So we occupied more space than we vacated. That might be weird if you have an increase in the vacancy rate and a positive net absorption, but we added in our survey about 250,000 square feet of new construction last year. And really it says while there was a good demand across the entire market, it just wasn't strong enough to keep up with the new supply in such a short amount of time. We're a small market here, things take time, markets move slow, and that was kind of indicative of that new space getting added on the market next year. So I think given that positive net absorption, and that 140,000 square feet of net absorption was the same amount if you look here between 2013 and 2016, that was the same, we were experiencing the same net absorption during that time as well. There just wasn't a whole lot of new construction happening at that period. That changed when we got to 2016, 17, and we started even before COVID, you could see the overall lease rate or vacancy rate increased. So let's dig into kind of where some of those trends are happening. So this is pulled right from our market outlook, which we have copies of downstairs, so you can pull these graphs. Really, I'm just showing you the downtown vacancy rates and the suburban vacancy rates. The orange bar is Class A, the light gray bar is Class B, and it's pretty clear where the market is right now, the discrepancy between A and B properties. Especially in downtown Portland. The Class A rate fell again this year to 4.1%, which is a great rate. It's a healthy rate. It's not where it was pre-COVID, down at 1 or 2%. But even that 4.1% doesn't really, there aren't a lot of vacancies, number of empty spaces in the market downtown, especially larger spaces, 10, 20, 30,000 square feet. There are very few options for tenants downtown. On the flip side, you can see what happened to the Class B rate last year. It absolutely skyrocketed from about 6% to 12.5%. And I think this is indicative of two trends that I talked about last year. I'll talk about again this year. One of them is the flight to quality. This increase, there were two major tenants that moved out of B buildings and subpar areas into prime locations, Class A buildings. And at the same time, the other trend that this shows is the conversion, the office conversion to residential and multifamily. So this past year was the first year since 2018 we haven't removed a dated Class B vacant office building from the survey. This drop that you see from 2020 all the way to 24 is this little superficial because that wasn't necessarily demand or absorption. That was us just removing vacant office buildings from the market because they were getting repurposed for residential, hospitality, and even one educational use. So then we move into the suburban market, much the same, Class A properties outpaced, at least in terms of where they were year over year. The rate for Class A properties in the suburban market fell last year to just under 11%. Still high, but much better than where it was before, especially for some of these submarkets in the suburban areas, including like Main Mall area, suburban Portland. The total lease or total vacancy rate for those markets last year was pushing 30%. And I think one of the stats I said last year was that those two submarkets alone accounted for 80% of the vacancy in the suburban markets. So that improved dramatically last year. The lease rates, asking lease rates fell roughly 3% in that market last year, and you had a 30% drop in vacancy. So I think that's trending in the right way. Class B also increased just similar to downtown, not as bad, but I still think this tells the story of that flight to quality, and we saw that in the suburban market as well. And there were some significant transactions signed in the suburban markets last year, over 10,000 square feet. There were a couple of years where I couldn't have named two, but I could probably name 7 that happened last year that made a big difference in the market. So that's kind of my overview of the data, and then we can hopefully get into the conversation later. You can ask some questions about the trends and where we see this all going next year.
Yeah, we're going to dig into some of this more in our roundtable discussion. So thank you, Nate.
Yep.
Sam, we're going to go to the industrial forecast here. So Sam, it's all you.
Great. Thank you. Again, Sam Leggett with the Dunham Group. I'm glad to be here with you all today. Before we jump in, just a quick thanks to Marina Turmel and Melissa Neptune in our office, not only for their help with this presentation, but our annual report, and obviously Justin co-authors that with me.
And the phone of friends there if you need it.
Yep. Justin, are you sitting near Mike? Of course you are. So today I'll walk you through what we saw in the industrial market in 2025, locally, regionally, and touch on nationally quickly. And then we'll talk about what that means as we move forward in our discussion later. So this year our survey encompassed over 1,050 buildings, just over 36 million square feet. we're reporting a total direct vacancy of 3.32%. And that's across the southern part of the state. For those of you who might remember, our survey covers Greater Portland, York County, and Lewis and Auburn. Lewis and Auburn was right around that same number, 3.34% this year. Greater Portland, 2.71%. And York County was actually around 5%. So how does that all break down? We're currently sitting at a 7-year high vacancy rate. And that headline alone obviously grabs your attention, but the context matters. In York County, for example, the majority of that vacancy, about 243,000 square feet, is in one building. And I'm sure that the listing brokers in this room will tell you that they've all felt the slowing demand on the industrial side of things. However, it's important to distinguish between property type and property size in that conversation. The large square footages are seeing less eyeballs, staying on the market longer than they have in years past. And smaller spaces, particularly under 10,000 square feet, are still moving relatively quickly. For cap rates versus vacancy, despite the higher vacancy, the stability of the asset class continues to drive investment demand year after year. Industrial real estate remains fundamentally strong. Investors still believe in it. The average cap rate this year was relatively flat, around 7.25%. That said, we may be nearing the limit of rent growth. Elevated valuations have forced investors to kind of push those rents higher to keep pace, but in doing so, they're still competing directly with owner users, and that dynamic has not slowed investor sentiment yet. So the real question, how long can this continue? Brings us to lease rates. Average asking lease rates this year were about $9.65 a square foot. Now, don't get me wrong, smaller spaces are still in that $12 to $14, $15, even $16 square foot range, depending on the product, the age, et cetera. But what's interesting in this chart is the slowdown in rent growth. So you can see that from 2021, we're only up about 10%, which I think we would consider a normal and healthy growth. But from 18 to 21, we saw almost 40% rent growth in that same time period. And the question I ask when I look at this is really, how much higher can businesses afford to go? Landlords have continued to push rents upward, but we're now seeing something new, and that's tenants pushing back. For the first time, pushing back successfully, given some of that softening demand. And businesses aren't just facing the higher base rent number. They're facing higher taxes, they're facing higher insurance costs, they're facing elevated operating expenses, all of which don't show up in this base rate of $9.65, but in most cases, in all triple net leases, they're being passed through to the tenant anyway. So it's important to keep in mind. And at some point, that math just simply stops working for businesses. Build-to-suit developments are also partially to blame for this dynamic. Most build-to-suit rents are in the high to mid-teens in order to just make those projects work and get them out of the ground. So that's created, obviously, a bifurcation between new build-to-suit product and existing properties. For sales pricing, similar to rent growth, sale value has seen fantastic appreciation, not only since 2018, but if you look at this chart since Justin started pulling this data since 2011, we're at $120 a square foot this year on an average basis. Now, from 2011 to 2018, that average growth was around 6% a year. But from 21 to 25, that number is close to almost 7.5%. And last year, we saw an 8.3% increase year over year. So I mentioned the demand for large floor plates has slowed, but smaller spaces are still very active. And in many cases, leasing brokers, I think over the past year, maybe even 2 years, have heard the same questions. Could we make an offer to purchase this? Is this property available for sale? And I know of multiple examples that those questions have triggered sales at exceptional pricing. So we've seen owners with no intention of selling a property, they put it on the market for lease. If it sits for a couple months, it's like, oh no, what's happening? And they say, okay, well, what's it worth? This is price discovery happening in real time. As far as national trends go, vacancy is between 7.1 and 7.3%, kind of depending on where you get your data. Most of that vacancy is concentrated in large kind of big box warehouse and speculative development. But across the country, the smaller assets remain tight, very similar to what we're experiencing here in Maine. Nationally, I think the development pipeline looks like it's bottomed out and is likely to stay below historical averages, at least in the near term. And I think that restraint in new supply is going to begin to put some downward pressure on vacancy rates nationally. But also similar to Maine, the demand across the country is for modern, purpose-built facilities that support automation, they support AI, specialized manufacturing. That demand remains strong across the country. So where does that leave us? We're not in a distressed market. I think we're in a recalibrating market. Vacancy is up, but largely concentrated. Lease rates are meeting resistance, but not collapsing by any means. Investor sentiment remains strong. And development here in Maine continues to stagnate somewhat. And the market is bifurcated between big and small, between build to suit and existing product, and between aggressive pricing and sustainable pricing. And I think that bifurcation is going to really determine and define the next 12 to 24 months. So thank you. Look forward to talking about the forecast with Nate and Jen, but in what you're used to with this presentation, we do expect to see Drake May back in the playoffs next February.
I think Justin's really happy to have passed the baton. Okay, so that finishes our kind of data dump portion of the panel. So what we're going to do now is sort of unpack all of the data that we've just heard from Sam and from Nate. And as you guys know, our market's pretty small, so these guys are obviously experts, in the office and the industrial market. But we're all going to have feedback on. So Sam, if you've got anything to say about the office market, feel free to pipe in, and Nate, vice versa. So we're going to start with unpacking some of what Nate had discussed with us. So Nate, obviously we're seeing a lot of shifts in work patterns, how offices are operating. Those 8 to 5, Monday through Friday in the office days are, have kind of come and gone. How are you seeing this, kind of reshape, the office market, both downtown and suburban?
Yeah, as I mentioned, kind of this slow growth up in vacancy rate over the course of the last 6 years, companies are still trying to figure this out. I think one of the trends, hybrid workplace, that is something that just everyone's embraced. It just is what it is. Even at our office, an admin goes home once a week or works from home once a week. So, I think that's been embraced. It hasn't really shown across the board in a reduction in square footage for tenants, but certainly it's just having an effect on how companies are thinking about how they use space and where they use the space, and that's part of that flight to quality. Last year, I actually called it a flight to experience, because it isn't just necessarily about a nicer building, but maybe it's a nicer area or a building with more amenities where companies can attract and retain employees easier. Or try to say like, hey, we're downtown next to bars and restaurants. Don't you want to come into the office? And so I think that's one of the trends that's shaping the market, not so much in creating more vacancy, but just a different type of workplace.
Yeah, I think, a lot of what we're seeing too is, getting that person to come in town. So, you go back to the basics, and it's location, 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 right? So where your office is, places for people to go after work or go to the gym during the day. So we're definitely seeing a lot of that. What are tenants doing, and how is, what are tenants doing to get deals done? So obviously, it's been a shift in terms of tenants market to landlords market. So what are you seeing landlords doing to attract tenants to their spaces? And it's, probably a little different downtown and, between markets as well.
Yeah, it's a little bit of a soundbite, but it's really amenity driven. And there are several landlords in town that have added golf simulators and gyms and shared conference areas. Those have been important, just because you might have a meeting once a week where you need 30 people, but you don't need it every day. So having a shared conference space is important. So I'd say amenitizing buildings, and also just staying on top of improvements, not letting buildings get too dated. And we'll talk about that, maybe a little later with regards to what landlords can do to, incentivize tenants. And
dig into that right now.
Yeah, yeah.
Let's
Just
go
quick,
there.
if I may, I was at a SIOR conference back in December. I heard a great slogan on that, and it was a landlord talking about aligning his interest with the tenants that they have, and he called that whole idea earning the commute.
Yeah.
Oh, yeah.
Yeah, yeah, I've heard that as well. So earning the commute. I mean, Portland fared much better, post-COVID than a lot of the other larger regional cities. I mean, it was just easier to get to your office space. Your commute was shorter in the greater Portland area than compared to New York or Boston. Companies were smaller, more nimble, locally owned and controlled for the most part, just easier to adapt to, are we back in the office? Are we not back in the office? What are we doing? But for amenitizing and just keeping buildings improved, I mean, with the downtown office market, you can see that sharp increase in the vacancy rate. Landlords can't necessarily pick up and move their building. And I think a lot of landlords are getting faced with, well, do we redevelop? Do we convert to residential? That's expensive, time consuming. Some buildings just aren't good candidates for it. Or do you renovate? And I think redevelop or renovate is going to have to be a question that some of these Class B landlords ask themselves if they have vacancies on where to go. But you got to keep these buildings fresh to attract the tenants.
Yeah, we've also seen some of these office buildings being converted, right? So into condos and hospitality. And, this kind of goes back to your comment about the Class B market having a pretty sharp increase in vacancy.
Yeah, well, I mean, it's funny, this slide right here, I think you can all see that. These aren't office buildings anymore. So I didn't mean to do that. I was just looking at the slide before getting up here. I'm like, these aren't even office buildings. But this is an example of two buildings that were removed over the course of the last 5 years because they're both moving to hospitality. So, that is a trend that actually Greater Portland did very well at. And I wrote an article about it this fall, but we removed like 10% of the inventory in downtown Portland Class B market for conversion. Relative to Boston, we blew them out of the water, and they even have conversion incentives in Boston. Compared to Providence, blew them out of the water. So there was like 700,000 square feet that was removed over the last 6 or 7 years in our market. So that's a trend that slowed last year. We didn't remove any buildings, partly, why the rate went up. But I don't think that trend is done. I think the low-hanging fruit conversions, like these two buildings were just really great buildings for conversion, giving size, floor plate, location, price. So I don't think that trend is gone. It's going to slow down a little bit. And I mean, we already just, sold an office building downtown on Commercial Street that will become hospitality. So it'll come back. Maybe not at the same pace over the last 5 years.
Well, I said like 4 hotels ago that we were done with hotels, so clearly my forecast was wrong on that. So it was interesting to hear that the suburban market vacancy rates were down. So obviously I know that there's a lot of suburban inventory, so pull back the curtain for us on that.
Yeah, I mean, that could be the old saying, it's hard to go much higher. There was a lot of space. There was a lot of opportunity. And I think tenants took advantage of it. There was a lot more negotiation happening with landlords. The asking rate, as I mentioned, fell 3% in the suburban markets last year. And that just created some incentives for tenants, to take advantage of the Class A buildings. And that's where the majority of the significant transactions happened last year. So it's really the Class A suburban rates that fell, and really, it's a question between Class A and Class B more so than it is suburban. And the suburban rate's still high. I mean, it's still almost 11%, which is the high rate. If I showed you the last 20 years of the Class A suburban rate, that's like the highest it's ever been. So it's not that, there's some amazing turnaround, but it's trending the right way and creating opportunities for tenants.
So Nate and I were having a discussion about the medical office market, which obviously has been very impactful in our area recently. So you want to talk to us a little bit about what you're seeing out there in the medical arena?
Yeah, so medical space, I haven't spent a whole lot of time talking about the last few years because it was just such a tight market. There was less than a 1% vacancy for probably 6 or 7 years running. And part of the reason, though, for the increase in the rate this year is the new inventory. Rock Row Medical Campus came online last year, and so that's a 250,000 square foot building that was added to the market that still has some space to lease. So the Class A medical market went from 0.8% to 7% this year. You can't read into that too much, but Jen and I were talking a little bit about demand. It's not, I thought the medical market in the past 6 years had been really well balanced. There was a low supply, but the demand was kind of iffy. If you look outside the three major healthcare users, it was spotty. So once you add new inventory, it takes a while for this market to absorb that amount of space in such a short amount of time. So I imagine that'll be up there a little bit. There are a couple other medical spaces that have been sitting. So I think that demand has been outpaced by the supply this year.
Good point. And then tell us a little bit about how you feel like our market is stacking up against the national market. And I think that probably has two components, both a downtown component and a suburban component.
Yeah, we're an interesting market that our downtown actually performed fairly well immediately after COVID compared to a lot of the other larger towns or larger cities in the area. Boston downtown is still dealing with, depending on which report you read, from 19 to 22% vacancy. We heard the talk earlier this morning with some of the life sciences buildings, kind of in Harvard Square, MIT area, Assembly Row, that vacancy rate's upwards of 30%. So downtown fared much better, and I kind of explained some of the reasons there. But even, Providence's upper teens in their vacancy rate for downtown office. Nationally, the rate, I think, fourth quarter 25 was 18%. So, we're talking 8.8%. That is a great rate. That is a healthy rate. And, I think the office market is stronger here than a lot of other locations.
I agree. I feel like, our market's kind of in a bubble. We don't see the high highs or the low lows. We kind of float in between. So thank you, Nate, for all of your insight. We're going to hop over to Sam, and there will be times for questions at the end. So let's talk a little bit about the industrial market. So we are at a 7-year high vacancy rate. Do you want to dig into that a little further for us?
Yeah, so as I mentioned, 7-year high, that obviously grabs everyone's attention. And I think one thing that's important to understand is a lot of this data has to do with timing. We pull this data in a certain date, the end of December. If you pulled it today, it might look a little bit different just because of how low historically our vacancy has been. And that 7-year high includes the 243,000 square foot vacancy down in Wells that I talked about. And that's a massive reason. I mean, without that, York County would actually go from about a 5% vacancy down to about 1.5% vacancy. So I think the story here is that demand has slowed and decision making is, arguably a lot more cautious than ever before. But I think that 7-year high is a little drastic just because of some of that data.
Yeah. Sometimes there's one piece that kind of drives it. So we have been noticing, though, obviously the industrial market has been our strongest market since COVID, with vacancy rates below 2% for multiple years in a row. I think the three of us have been chatting about all of our industrial inventory seems to be sitting a little longer, and it seems to be, the smaller stuff seems to be kind of flying off the shelves, but, the larger vacancies seem to be sitting around a little bit longer. Can you dig into that and what you're seeing and where that kind of square footage barrier is?
Yeah, for sure. So to your point, obviously coming out of COVID, the market just kind of went crazy. And it kind of became the new normal that if you had an industrial listing, it was going to lease quickly, and you had 4 or 5 companies that knew that they wanted the space within a matter of weeks. And so it's a little bit of resetting expectations that we're kind of back to, a normal-ish, healthy time on market type of market. And the leasing demand, I think Justin pointed it out at the time, but it really started to slow in like quarter 3, quarter 4 of 2023. And at that point, he pointed to slowing consumer confidence, some macroeconomic uncertainty, and those are obviously still true today. And I think you can add obviously tariff policy and job reports to that list of why decision making has become slowed and very cautious.
Yeah.
Another piece to that, I think, is obviously just, I think overshot is a strong word, but overshot the COVID market. We went from just-in-time warehousing to just-in-case, and people took a lot more space than I think they ultimately needed long-term, but they had to have it at the time to get that done and to keep their businesses humming. And some of those are starting to come back into the market, and not everybody's renewing at those square footages that they took at the time. So I think that's part of it as well.
Yeah. One of the things we're seeing some increased interest in, and it's kind of quasi-industrial, is self-storage. So there's a couple of kind of larger national self-storage companies that are up in the area, and they're actually kind of taking over the sites and demolishing the existing buildings. So that's kind of I think a new trend that we're going to see in 2026 is some more self-storage. So which I guess compares well with the housing that's happening here too. So. Let's talk a little bit about asking rates for existing inventory versus new construction, and as part of that, are we seeing any new construction given the shift in the market?
So as I mentioned, there's a bifurcation between the existing inventory, and if you look at our market as a whole, I would venture to say 70 to 80% of our market is probably 20 or 25 years old or older at this point, and we haven't really built a lot. We haven't built almost any speculative development. All of our new construction seems to be in build to suit. And, like I said earlier, those rents have to be well above what the existing inventory market is to make the economics work. So given the capital costs, elevated soft costs, I think is an issue, and site costs have gone up significantly over the last year. That bifurcation kind of continues to widen. But the existing inventory, I mean, your manufacturing type space is easily in the $8 to $10 a square foot range. Your warehousing space is $10 to $12 a square foot, depending on where it is. And that flex space, that small flex space, still tends to grab the highest dollar per square foot, and the demand for that is stable and steady.
Yeah, I think forever and a day when I first started in this business over 20 years ago, it was, $350, and then it jumped to $650, and we're like, oh my God, it's gotten so high. So we're up, it's funny because some of the industrial rates are actually rivaling office rates. Yeah. So we've had deals done in our office where you actually got an office deal done at a cheaper rate than an industrial deal was done, and that's a pretty significant shift that I've never seen in my 2 decades.
Yeah, I mean, the average asking rate for downtown Class B office space is $21 a square foot modified gross. And if you throw an $8 square foot OpEx in there, that's a industrial space.
Yeah, I mean, there are some suburban office market deals getting done in, 10, 11, 12 bucks a square foot, triple net. So so that's a very interesting shift that, I don't think in any of our career timeframes that we've seen. So so that's been, I guess a little humbling in some.
Yeah, and I think that those asking rates are going to level out a little bit. We'll see some bigger numbers because I do think we're going to see some more new construction. Certainly on the build to suit side, like I said, some of these bigger companies and even some of the smaller local companies, their demands from a specification perspective require higher ceiling heights, more parking, just more modern type buildings, and we don't have them.
Right.
Yeah.
Yep. No, absolutely. Let's talk a little bit about the sales side. So are you seeing most of the sales demand from owner users, or are we still seeing some investment sales happen in the industrial sector?
Those two buyer subsets are definitely still competing, investors and owner users. As mentioned, some of that's coming from the for lease market inventory because there's just not a lot of for sale inventory that's totally right sized. But it's still, I think, a healthy mix between the two. And sale pricing, I think, from a forecast perspective, is going to continue to climb. I mean, we're at $120 a square foot on average now. I realize that there's a lot of deals happening every day in the $150 a square foot range and even higher. But I think that's going to continue to go up. I mean, I wouldn't be surprised at all to start seeing numbers in the $200 a square foot range, even for bigger buildings.
Yeah, I mean, I think the industrial market's one of those markets too, where the quality of the building, there's a significant range from, $100 square foot building to a $200 square foot building. So, they're not all created equal. So it's, it's an interesting market in that regard.
Yeah, it definitely skews the average a little bit when you're talking about a manufacturing building built in the 60s versus,
a lab, or,
or even something with 16-foot clear height built in the 80s. It's
Right, exactly. So talk to us a little bit about how our industrial market, our local market compares to, what you guys are seeing nationally.
For me? Or?
Yeah, for you, okay. For the industrial.
So nationally, as I mentioned, that vacancy rate is quite a bit higher. But in Boston, for example, that vacancy rate is kind of 10 to 12%. And the big differentiator there is speculative development. Post-COVID, there was a lot of demand or speculative demand for big box warehousing, e-commerce, and distribution. And not all of that has been absorbed at this point. We as a state, unfortunately or fortunately, I don't really know, it depends on what side of the table you sit on, have not built speculatively. And that seems to be kind of the major difference, I think, certainly in vacancy rates. But nationally, I think that the number of construction starts has slowed dramatically. So that's going to kind of bring the national vacancy rate, I think, probably a little bit closer to what we see here in Maine.
Yeah. Right. Well, this is the forecast conference, so I want to ask both of these guys, Nate, and I'll start with you. What are your predictions for 2026 so that we can roast you next year and see if you're right or wrong?
Yeah, no one remembers what I say out there. Come on. Any of you watched the video of what I did last night? I'm just kidding. Actually, when I looked at my graph a couple years ago, the first one with the orange bars, I had done like a 3 or 4 year projection, and I was pretty close. I got to give myself credit for that. I think we're going to continue to see Class A market and Class B markets kind of differentiate from each other. I expect Class A, that's where the demand is this year, especially downtown Portland. There's also a healthy demand in the suburban market, and even 2 leases in the main mall area, significant leases were signed in the last 45 days. And those weren't counted in our survey. So, and, barring any surprises of large vacancies, I think the Class A markets, both downtown and suburban, will remain, will continue to go down. The whole reason the vacancy rate went up last year was really because of Class B properties. I don't see the Class B market downtown going much higher. Maybe one of these buildings is turned into a data center or something. But I think, B will kind of flatten out a little bit. Suburban market might go up somewhat. Really depends on how landlords react to the flight to quality. The downtown asking rates for Class B properties went down 5% last year, and that didn't make much of a difference in the vacancy rate for B downtown. So landlords are going to have to do more than just, change the price on the brochure, and we'll see whether landlords respond to that or not.
Yeah. Sam, what are your predictions for 2026?
So I think the supply and demand kind of pendulum is swinging to the center in favor of tenants. And landlords are, I think, going to, if you've got the deal and you've got the action, you've got the demand, do the deal. Lease rates, I think, are going to flatten a little bit on an average asking rate basis. But new construction, like we said, is going to see some of those higher numbers. Vacancy, I think it's going to be elevated, and it may be down year over year again because we've got that kind of one big building down there in Wells that's dragging that a little bit. But I think it's going to be elevated over the past 2 to 3 years, for sure. And sales, definitely higher pricing. We're not even close to replacement cost yet. So, like I said, I think that's going to continue to go up. Cap rates, I think, will remain pretty stagnant, kind of where they are, and demand is still steady and cautious. But the big thing on the new construction that I forecast is I think we're going to see a couple of big buildings either in idea or, get to a letter of intent, maybe not get shovels in the ground, but start the permitting process from a warehouse kind of e-commerce space like we're talking about, but also in the specialized kind of, niche style buildings and specifically sports. Everybody's got kids that are playing sports, and everybody thinks their kids are going to play in the Olympics and all that. So the training programs for some of these basketball and baseball, and we've seen some of it with pickleball, and yeah. So I think somebody would do really well if they have the land and it's right size and you've got enough parking, that a sports type facility would do really, really well.
Both indoor and outdoor.
Correct.
Personal stake interest in this too.
Jen, if I could get back to the office outlook a little bit.
Yeah, absolutely.
2 things I haven't really talked about much in the last 4 or 5 years because there hasn't been any activity in it. It would be the office sales, investment sales, and as well as new construction. One office building in downtown Portland sold last year. There's another big one under contract right now. I think as investors start to realize that the office market isn't as bad as it was, and there is only a 4% vacancy downtown, and there is a high demand, and there is positive absorption, I think we'll start to see some of those investment sales come back. On a new construction outlook, can you imagine someone building speculative for office space?
Not gonna happen.
No way. But I used to show this graph pre-COVID that showed every time the Class A rate downtown got below 2%, it just spurred new construction. And we're at 4.1%. We're not quite there. But if the tenant comes along that needs 30, 40, 50,000 square feet of office space and they want to be downtown, there's really no other option. So
That's an interesting point. So, if you're looking for a large chunk of space downtown in the Class A market, it doesn't really exist. I mean, there's one or two spaces maybe over, that you can put a large chunk together.
Yeah. I mean, the major difference between the two obviously is going to get down to construction costs. The average Class A asking rate downtown is $28 a square foot modified gross. You need to be high 30s triple net for a new construction building. So if someone's willing to pay the weight.
Yep, exactly.
But even where you can find the space, I think downtown, what I've heard from a lot of users recently is they don't just want the space to be contiguous across multiple floors. They want the whole thing on one floor.
Right.
It would really be the preference, and that definitely does not exist.
Hard to find in our market. So we have purposely left a few minutes for some questions from the audience. So please feel free to step to a microphone if anybody has any questions for Sam or Nate. Oh God, Justin, really?
This
Here
was
we go.
This
Here
was
we go.
planted. Come on.
I have a lot of questions. No, Nate, really good job. Jen, awesome. Sammy, pretty good. Sam, I'm glad you pointed out the operating expense thing in regards to triple net costs, because I've really seen that. I just did a deal yesterday. It was a $10 a foot deal, and the triple nets were like $6 on an industrial deal. So how are you coaching the landlords to account for that? And are they trying to keep these costs down? And do they understand that the tenant only really cares about what the total amount is? Right. So $16 a foot, to your point earlier, I think is getting to the point where a lot of businesses just can't afford that in the industrial market.
Right. Yeah, for me, that would be, I'd be coaching them on a strategy of kind of test the market. The education is there that, hey, that is a big number from an operating expense standpoint, and you need to be aware of it. And from the idea of, are there things that you can do to bring that number down, because it's going to make your property, more competitive. But in some cases, depending on the space, they're going to pay it because they have to. They need the space. But it's an education piece, I think, you need to be aware of this, and if there's something you can do about it, you should do it.
Any other questions out there? Oh, Justin can't be the only question. Come on. No other questions? Oh, here goes Brandon. Here we go.
I'm surprised he's smiling.
It's just curiosity, and it's not industrial. It's more office. Nate, just curious investment purchases for office downtown. How are the financing? How are the banks looking at that? Is that are they still running away from it, or do you think that could be a hurdle that an investor would need to overcome?
Yeah, it's tough. Banks, even investors at some point, take a macro look at the market, and so they're not looking at just Portland. So cap rates for big office deals downtown are, you can get an 8% cap rate. Not many people are willing to sell at that point, but yeah, I think they just need to take a macro look, so they're not as friendly to office investment, but their deals getting done. There's definitely happening.
Oh, thank you.
Any other questions?
Just had one general one in terms of your response to Mike Costa's presentation and his commentary about there being $140 trillion of private equity currently versus 2014 to 65 trillion, and its impact on us.
Yeah, Maine has always been a tough place to attract that capital money. There needs to be some local connection. But I was talking with a client who had been on a call with some other large landlords, had their own properties throughout the country. And someone on the call said, hey, what about Portland, Maine? Have you guys taken a look at that market? And a couple of the other people on the call said, yeah, Portland. We hadn't looked at that before, but we're looking at that now. And I even got a call from a developer out of Chicago 3 weeks ago who just grew up in Vermont, so he's starting to look at deals in the Northeast, and he was just attracted to the Portland area. So, yeah, I'd love it if they could invest more in Portland, but we're a small market compared to the rest of the country, and it's hard to spend that type of capital in this market, honestly. But we can get a piece of it. That'd be great.
Yeah,
Positive sign all around for commercial real estate, honestly.
and I would say the national interest with some of that big money that he's alluding to is definitely looking at Maine more than they have in the past. I just don't know how much it's really, how many deals have actually happened at this point.
Yeah. Once you get into the demographics of Maine, they cool off a little bit.
Yeah.
Follow-up, do you think there's any impact on inflationary forces here on cost of building materials, cost of labor, big contractors who are available to work here in Maine?
I mean, the cost of construction, the cost of labor is definitely a hurdle that we have to overcome. When Jen was saying, how do you attract more tenants to your office building? Well, if you can give them more money for their build out, that'd be great. If an office construction job costs $100 a square foot, landlord's only going to be able to cover 20, 30, maybe $40 a square foot. So where's the rest of it coming? It's coming out of the tenant's pocket through a loan or through cash. Landlords can only offer so much money based on the lease rate and what they're getting for return. And if their net income on that space is $10 a square foot, that doesn't leave a whole lot of money to start paying $100 square foot construction deals.
Yeah, and if you tailor that piece to the medical market, I mean, we're seeing medical fit up for just clinical medical fit up at like $350 a square foot. So that's a big, 10,000 square feet. That's $3.5 million that their practice has to pay for just their fit up. So, the construction costs have continued. I think will continue to be a bit of a hurdle for sure. So.
Yeah, I do think folks are getting a little more creative with their build out. Everyone gets a private office around the entire perimeter is less of a trend now, and that means less walls and less construction. It's more about amenity-driven conference rooms, meeting spaces, living room areas in your office space, and that just costs less money.
Quality piece, right? Yeah,
Exactly.
Yeah,
Yeah.
it's the quality piece. We got Mark Malone with a question.
Good afternoon. I'm curious, I haven't heard any comments about, at the risk of kind of throwing a wet blanket on downtown, what about the drug use, the mental health problems on the streets? How is that impacting tenants' decisions to expand in Portland or to move or,
Okay.
You want that one?
You want how? Yeah, we'll back you up here, Nate.
Yeah. No,
where-
I mean,
where are they-
it hit a headwind last summer. There was a lot of commentary in the press. Landlords went to city council meetings to talk about it. And I do think the city listened. There had been improvement projects, just even putting ping pong out in Monument Square. Seeing who was playing that last summer was super interesting. But so I think there's an effort, there's a recognition that it's a problem, and there is an effort. There's a new community policing office that's going to open up in Monument Square. And so I think the city recognizes it. But that is certainly, I didn't represent the tenants that moved off of Congress Street, closer to the Old Port, but I have heard that that's a major reason. And having to keep your door locked 24 hours a day because you don't want someone just barging into your office, that was a concern. And so I think that was part of the equation. And, I have a listing for sale in Monument Square. So I am trying to paint the pretty picture of where I see that area going in the next 3 to 5 years. And it's only positive. You have 2 new hotels opening up. The museum is undergoing a huge capital campaign for a new building. There are multiple other capital campaigns happening with nonprofits on Congress Street right now. I think it's a group effort. You have the Friends of Congress Square. There was a group that met for Monument Square, just really how to make things better. And unfortunately, we're not going to solve the homeless or the drug issue in Portland, Maine. This is a national issue. And, I think Portland can address it the best that we can. And I think it's about engaging the area and bringing more people to the area. And I think, the office moves that have happened, but I think that will bring people back to Portland and in turn will bring office users back to Congress Street.
I did represent one of the companies that, moved off of Congress Street, and they stayed downtown, but they went to a more of a more downtown in terms of, Middle Street, Commercial Street area. And it was a 100% safety move. There has been some issues with people walking to their cars at night and, people getting followed into office buildings and that type of thing. So Congress Street particularly has been difficult, I think, for the downtown market for sure, Mark. And I think, people are trying to get their arms wrapped around it. It's a big problem, and I think it's a big ship to move. But hopefully, I too represent some space on Congress Street. So, it's just getting bodies up there and keeping the storefronts full and getting people in the buildings. That's really what we need to do, and it tends to shift things. So,
Yeah, and I think, to Nate's point, if you have the long-term view, I think people are excited about what, Monument Square, Congress Street can be again. But in the short term, it can be a cost decision as well. I know of a couple of clients that they're paying for after hours and before work security to get people safely to and from their car. So at some point too, it just becomes, hey, this is just costing us more money.
we unfortunately have to wrap up. I'm sorry, I'm getting the red flag out back. So I want to thank Sam and Nate for all the time that goes into this. This is, it takes time and effort out of your normal business day. And thank you guys for all being here. And we will all be around if anybody has any questions.
Thanks, John.
Thanks.